Welcome to the show, everyone. Man, it has been an interesting weekend. We're going to start off with some real estate stuff. The chat is working again. So, Saeed, Rajil, I appreciate you boys testing me out. We're here. We're live. It's good. So, every once in a while, I get some technology right. That being said, man, Jerome Powell making a statement late on Sunday night, which talks about being possibly indicted for federal charges. There has been a lot of housing rhetoric, something we follow closely on the show for quite some time. So we're sitting in a situation where things are going to get a bit volatile. And to that end, I have some chart work. We've been doing some hedge fund analytics in the back end for the show, which we have not been openly talking about, that are going to make its way into this show. My only caveat right off the top is some of this stuff is still in beta, so it's not 100% aesthetically like where I would want it to be, but we'll get it there. So let's talk about the market a little bit today, and let's test some chart work, shall we? So I'm going to go ahead and show you the old stock view real quick. This is it. You can see how we looked at stocks as they came up, but one of the things I have been working on is this chart here. This is going to be our U.S. market risk profile chart. Again, this is not 100% production ready yet, but on days like today, it seems appropriate. So what this is going to do is this is going to allow us to look at the markets in a different way. A lot of people in the traditional media and online will look at things like the Dow, the S&P, the NASDAQ, the Russell, and the QQQ as proxies for the overall market health. The problem is those numbers don't mean anything to most people unless they have had some experience in the markets. This chart is supposed to remediate that for a lot of you out there watching, saying, hey, I don't know what the market's telling me. So we've done that for you. What we've done is we removed the indices, which can have some volatility and some delays, and we've substituted in ETFs. So in this case, DIA, SPY, 1Q, the IWM for the Russell, and the Invesco QQQ is an ETF in and of itself. Doing that has allowed us to then take a real-time actual money being converted ETF and come up with an approximation for what type of market we are in at any given time. We're going to use this chart heavily in the future for the risk profile on every single show. And you'll know straight away, based on what this chart is telling you, whether we are in a broad rally, a growth run, a mixed day, defensive, so on and so forth. And I'm actually going to add the definitions over here on top of this piece there, the market open, the bottom, so you can actually see what a narrow rally means. But this is a straight quantitative analysis of the markets at any given time, and there is no opinion here. This is just what it is. And because we are such a tech-heavy driven sector in the QQQ, one of the things we wanted to do was make sure that we differentiated between a tech-led rally and a growth rally. So to give you guys an idea of what I'm talking about specifically, if you look here on this chart there, we added a tech-led sector. So we really essentially know if the Mag 7 is leading the way on any potential growth run, we're going to identify that. And if you'll notice, the color spectrum here isn't exactly what I would call green for growth, because what we're going to do in the future is say that anything that's really a growth run and above a broad rally, that is positive trending. Anything really between mixed day and down this way is going to be defensive, risk off positions, and liquidation. And for those of you used to traditional vernacular, a growth run, tech led, and even a broad rally would be risk on. I would say that tech-led would probably be a risk on light, if you will, in certain categories. So the idea here is to bring you more hedge fund style analytics like this, which would be more of a dashboard view at any traditional hedge fund, and then layer in complexities. We're also working on synthetic risk models and some other stuff that we can show with you that nobody else is really doing. And we hope that this ultimately is going to give you some type of perspective that you think is valuable in the markets. Let's switch back here to the desk view. And I promise that'll come on board and be a lot more pleasing to the eye over time. So without further ado, the market started off, the S&P started off today down a little bit, which is not to be surprising based on the news that we saw earlier in the weekend. Jerome Powell coming out, giving a presentation we're going to look at here. But the S&P erased losses and turned green, now less than 30 points away from hitting that 7,000 for the first time in history, which is kind of striking after you see all this volatility in the markets. Dip buyers are already back in full swing as assets soar across the board, and you're seeing that in what I just presented you in the market status. Everything was effectively green, really telling you what the market is thinking, at least now emotionally. Now I'm going to go ahead and pull over onto my screen here, Jerome Powell's commentary. We're going to listen to it and we're going to react in real time. So let's go to the screen here real quick. There you go. Oh, it's not showing. Let me fix that. Give me 1 second. Sorry about that. Sometimes when you run a network style setup, it takes a little bit of time. There we go. There's Jerome. Uncle J Powell, and let's get this going.
Good evening. On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening a criminal indictment related to my testimony before the Senate Banking Committee last June. That testimony concerned in part a multi-year project to renovate historic Federal Reserve office buildings. I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. I have served at the Federal Reserve under 4 administrations, Republicans and Democrats alike. In every case, I have carried out my duties without political fear or favor, focused solely on our mandate of price stability and maximum employment. Public service sometimes requires standing firm in the face of threats. I will continue to do the job the Senate confirmed me to do, with integrity and a commitment to serving the American people. Thank you.
Wow. Yeah, that was a shock to me. I was driving home from Disneyland with my wife, and well, we saw that bad boy come up, and I thought to myself, like, that's insanity on some level. And I guess it was to be expected a little bit from some of the things that we've seen rhetoric-wise in the media, and we certainly saw some of this being attacked, and it was not to be, I guess, underestimated that if the president's being sued, he might sue other people vis-a-vis the Justice Department, or the Justice Department might feel the need to do that on his behalf. But certainly a strange set of circumstances for somebody who's going to be leaving the chair position by May. And then you think about that in the context of he's still going to be there as a member of the FOMC, but not the person who makes the decision. It certainly was historic, at least it felt like to me. And I think the interesting thing is when you look at the media here and the response, this chart is really interesting. I want to look at this a little bit too. Where does price stability part of your mandate begin? This is a criticism here. And if you look at the price stability, that is actually a decent argument. And I don't want to downplay the severity of suing somebody for doing what he believes in his best interest. So I guess one of the things on the show we promise never to be is political. We don't try to comment on the political zeitgeist one way or the other. We want to be even, giving both sides of the equation. I tend to think that someone like Jerome Powell should not be sued personally for trying to do his best as a fiduciary. Now, lying in a grand jury is a personal crime, if you will, and they would have to prove that out. But he doesn't have any benefit to lying. What's his economic interest in doing so? If you're saying that it's only to further his career, I would argue that that is not significant enough to violate the sanctity of protection that should be afforded to somebody in doing their job. Certainly not legally anyway, but again, grand jury, different set of circumstances. But this is the other side of the equation, right? The Fed has two primary responsibilities. It's price stability and low unemployment, or stable unemployment, if you will, or employment. And if you look at this chart here, let's go back to the wider screen so we can get a bit bigger chart view. This is consumer price index for all urban consumers, all items in the U.S. city average from 1950 to 2025. And the criticism is a sound one here. Like, I get it. It's where is the stability? If this is where price inflation is gone, right? If that's where we're seeing prices go, is the Fed doing their job? Are they really keeping things even? I mean, this is a pretty significant, steep increase. You could argue that, okay, things go up over time, but shouldn't price stability stable be there, or price stability be somewhere not so hockey stick like. And again, some of that is within the Fed's purview and control, and some of that, well, it's not. I mean, some of that is going to be the political zeitgeist and all these things that are happening outside of them. The stimulus checks were not on the Fed's, bingo card. They're not the ones who made that decision. They're not the ones who decide on things like tariffs. So there's a lot of finger pointing. It reminds me a lot of the old Spider-Man, everybody pointing at everybody else kind of situation. But certainly, if you look at the chart work and you think to yourself, like, okay, hey, this is a problem. Let's look at this statement too. Darth Powell's a great account I follow. If you don't follow it, it's in one of those anonymous accounts on X. But there's some pretty good stuff that comes out of this account, and I tend to look at it and laugh from time to time. Who stole the American dream? Ben Bernanke, 1.54 trillion in mortgage-backed securities via quantitative easing. Yeah, that was him. Janet Yellen, 177 billion in mortgage-backed securities via quantitative easing. Yeah, well, that was her. And Jerome Powell, 403 billion in mortgage-backed securities via quantitative easing. So the question logically is how the Federal Reserve stole the American dream by artificially inflating home prices by manipulating interest rates. And this chart down here, if you're looking on the vertical channel, it's going to be hard to see. Basically shows that home prices collapsed at that point down there. Okay. Then the Federal Reserve starts things at this point, and this point of mortgage quantitative easings, right? And then mortgage rates will fall to resolve this issue. I don't know that any of these things can be addressed in what the president has telegraphed will be his upcoming conversation in Davos. And a lot of you are saying, well, he's got a plan, right? Well, if he does, we don't necessarily know it. I can only tell you what I've seen of his plan as of late. And that right now is not what I would call hyper detailed. So let's go to the screen here so I can show you exactly what I'm talking about. Actually, before we do that, let's pause. The president is going to be speaking in Davos. It's the World Economic Forum. This is a big deal. Anybody who's anybody in the finance community will be there. Clearly, I'm not invited, which, justified. At the World Economic Forum, I would say it's probably not the best place to announce new economic policy, but it is a big scale to get in front of a lot of eyes of a lot of country and a lot of people with international media. That is not to be overlooked here. You do have the midterms coming up, and the pundits on the other side of the aisle would say that this is all show for the midterms because they believe that a lot of what's happening now is trying to keep the House and the Senate in the Republican-dominated position so that the rest of the presidency can go easier or at least get more accomplished from their perspective. And again, totally neutral on the opinion here. So you can see that there is something larger playing out here that we don't necessarily understand. And that's okay. It doesn't necessarily have to be something that we understand now, but there has to be a plan put in place, which we can all adopt and believe in, which I don't really necessarily know that we have one as of this particular time. And to give you an idea of what this does before I get to the next slide, which I think is important to talk about, I want to talk a little bit about let's see if I can pull it up here, Trump's plan. And I want to talk a little bit about what this may or may not be. We don't really know. There's some things that aren't going to work. We know that right off the top. And I'll say that that's most likely going to be 50-year mortgages. I think the world pretty much unilaterally said no to that. This from CBS News. Trump has a plan to make housing more affordable. Will it work? President Trump last week proposed 2 policies aimed at reducing the cost of buying a home at soaring prices and elevated mortgage rates. Make homeownership increasingly unattainable for most Americans. Mr. Trump said he plans to ban large institutional investors from buying single-family homes and is also directing the federal government to purchase $200 billion in mortgage bonds to drive down mortgage rates for Americans. And there's also, of course, the third thing which he talked about, which was 50-year mortgage rates. I think that was resoundingly a non-starter. I think the institutional change here is also a non-starter. I don't know that the $200 billion in mortgage bonds to drive mortgage rates down will really do it. But again, in the executive branch's defense, I don't know that this is necessarily something they can control. I mean, there's a consumer element here, which is important. You can put in rules and restrictions, but then again, it does kind of run afoul of the traditional notions of capitalism, if you will. So it is one of my many steps in restoring affordability, Mr. Trump said in January 8th social media post of the proposed mortgage debt purchase. Buying a home has become far more expensive in recent years as home prices have surged, driven by a shortage of affordable housing and, since 2022, rising mortgage rates. But because most Americans, most of those pressures lie beyond the federal government's direct control, hence what I'm saying to you about I don't know that it's executive branch control, It's unclear how much Mr. Trump's proposals could ultimately lower costs, according to experts. I completely agree with that sentiment. I don't know that there's a clear delineation there. This goes into America's housing shortage, why lower mortgage rates aren't panacea, and some more details here. But this is actually some pretty interesting stuff that we talked about on the show, and I thought this was actually really cool to share because this really, and again, I saw this article probably 10 minutes before I came live, but it's really fascinating to me, at least, to see that this is the narrative that's out there as well beyond us, the show. And I'm really talking about this piece here. What they're trying to suggest is that qualified income and actual median income have not risen relative to home prices and relative to that inflation that we saw at the beginning of the show. And if that has not happened, this seems like the easiest way for most Americans to buy a home is either home prices come down or they make more money, because interest rates seem to be ineffective at solving this problem because there are ramifications to them going up or down. They go up, homes lose value. Now, there is a case here, a scenario with which I think we should all consider to be a reality. 40% of the homes in the United States market are owned in cash, paid off, no mortgage. That's a big number. And according to some data I have here, I'll share with you in a couple minutes, 20% of them, 1/5, 1 out of 5 homes have a mortgage rate less than 3%. If you think about it in the context of that, there is room for values to go down and not meaningfully impact the livelihood and financial position of most Americans. Again, these are unrealized losses because unless you're planning on selling the property in the not too distant future, you really haven't had your lifestyle change one way or the other if values went up or down. This is not to say that I'm not sympathetic to the idea of values changing. It's just that I don't know that this could really meaningfully do things. So if the government buying about $200 billion in mortgage securities, it could reduce home rates by about probably a quarter of a point to 0.35 percentage points, which could spur more spending, right? That could get people to buy more properties and then thus increase the value or keeping values where they are. That doesn't solve the problem. So lower rates, again, you'd have to be below 3% to entice 1/5 of the market to even get in there and refinance, and then that's still not selling. And then 40% of the country owns their home in cash. So I don't know that solves the problem. I think Americans need more money. Is what it is. I know that's an ugly truth for a lot of companies. People don't like hearing it, but that's where I think we're at right now. And I think the upshot is that meaningful progress will require tackling the shortage of available homes. And I think that supply is a big issue here. And I think there's a slow, prolongated burn that most likely will solve this problem. And let me explain. Went through 14 years of artificial interest rate deflation. And post-pandemic and all these things, you got stimulus, and we held rates artificially low. And we are now dealing with the reverberating impacts of that over time. Historically speaking, this is your sine wave, right? And I'm going to go around my face there, so I'm still pretty in the middle. Hey, there you go. This is a peak, and that is a trough. And traditionally speaking, this period here, peak to peak, is somewhere in the neighborhood of 7 to 10 years, okay? And of course, the other side of the equation is about the same from trough to trough, and it's cyclical. Recessions go up, recessions go down. This is a cyclical paradigm. It should not surprise any of you watching this show that this is the natural order of things. But what we saw recently was we saw somewhere, I'll call it about 15 years of artificial interest rate deflation. And if we saw the most prolonged period of prosperous economic times, which means really, again, from one top of the curve to the next top of the curve, this gap, right, was 50% larger than it maximum had been historically. It is a natural, logical conclusion to draw, and you don't have to be an economist or a data quant to say that it should take longer to remediate the economic positivity, this prolonged period of artificial interest rate deflation and this rapidly growing economy. It should take a prolonged period of time to reset that because we just went through the longest period of history of this prosperous time. So I don't want to sound grim or dark, but I do think that's a meaningful thing for us to define and be distinctive of. Because a lot of people on talking heads on social media, and including me here, we're talking about things, but we don't really know. This is unprecedented, uncharted territory. When was the last time you saw, Jerome Powell or this sitting head of the FOMC be brought under charged under a grand jury. It's just crazy. It's different. And I'm not again taking a political position. You could argue Jerome Powell has not been effective in his job, but firing him because he's not effective is not necessarily something you can do. And this looks like an end run to do that. And there's a lot of, I guess, Republican candidates have come out recently to defend Jerome Powell as of this morning. I didn't check because I don't want to get into the political side of things that much, but I do think it's worthwhile to talk about that on some level. And I also want to spend some time going over another real estate valuations impact chart. I think real estate being impactful here is important, but let's go to the social view. Here you go. This is Lance Lambert. 50-year mortgage proposal dead on arrival. I think I was pretty clear when I said that I think most people felt that the 50-year mortgage was insane. We covered that on the previous live that we did on Friday last week. You can go back and check that out. But basically, the mortgage interest you would pay on a $400,000 home, which is less than the average in America today, incrementally, but still less, you would wind up paying significantly more for the home than you would with a 30-year mortgage, but you would effectively pay, I want to say, about 2/3 of the payments over time. Over $1 million would be interest. So here you go. Institutional home buying ban, outcome unknown. We'll see what happens in Congress. So I guess the supposition here by Lance is we don't even know if this is going to get past Congress or be allowed, or if it's actually going to happen. So far, we've seen commentary to that effect, but we haven't actually seen anything happen. GSE is adding about $200 billion in mortgage bonds. I just told you somewhere between 25 and 35 basis points change in mortgage rates. So there is something there. To his point, there is meat on those bones. GSEs had already started ramping up their holdings before the announcement. So we saw this already starting to happen in the market. So it wasn't anything that I think was pretty wild here. But here you go. Look at this chart here. Let's go to the screen view. Retained mortgage holdings by government-sponsored enterprises, Fannie Mae, Freddie Mac, according to John Burns Research and Consulting. Big fan of their work, by the way. Fannie and Freddie have already added about $70 billion to the retained mortgage portfolios since May of last year. Adding another $200 billion would basically put the GSEs, their legal cap, $225 billion each, writes Alex Thomas, research manager at JBREC. So that's actually something to think about. If we have seen this increase in mortgage-backed holdings already, and this is month over month. So you got July, August, September, October, November, right? And we've already been trending in that direction. Did the president come out and take credit for something that was likely going to happen, or did he call them and say, "Hey, go to your absolute maximum," which in this case is $225 billion each? And is this fighting the Fed's position? Who's right? Who's wrong? I don't really know. Again, pundits on both sides of the aisles. I can just tell you we were already heading down this trajectory. I don't know if we're getting any benefit we would not have already gotten from this particular thing. So when you think about it in the broader perspective, and you go back to the view here that I'm sharing, and you say, okay, well, so a 50-year mortgage proposal was announced. The market moved a little bit in response to that, but there was a lot of negative feedback on social media for good reason. It economically doesn't make any sense. Institutional home buying ban, outcome unknown. We don't even know if it's legal, much less if there's going to be any SEC challenges to that. Not to mention there's this whole low-hanging fruit, obvious thing that the home builders who really have only controlled. If you have a institutional buyer that has 1,000 or more properties, that's less than it's about 3% of the market. If you qualify institutional buyer by people owning 100 properties or more, it's about all in maybe 7% of the market, maybe a little bit more than that, a little bit less, but it's not going to meaningfully move the market. And people like Blackstone, who get a lot of hate, have been net sellers of real estate over the last 10 years. They put out a whole statement to that effect, and it was actually accurate. So hard to ignore that. So then you think about this and you think about the context of where we're going here. Okay, so the GSEs are going to do this, but they were probably going to do it anyway, going up to their maximum. In order for their maximum to go up, there'd have to be some changes of some rules there, which can be done. I mean, sure. But then you're fighting the Fed actively, at least for the next 5 months or so until Jerome Powell is out. And let's be clear about kind of the bigger zeitgeist here. You already have Myron in the FOMC, who is very aggressive, feeling that rate cuts are more important. But again, even with that, and even with the potential idea of Jerome Powell going out and leaving, you also have people like JPMorgan, Uncle Jamie stepping in, and they no longer expect Fed rate cuts. They predict hikes in 2027 now. So you got the largest bank in the world now saying, you know what, we're not expecting rate cuts. We actually expect rate hikes in about a year. And they're baking in the idea that Myron's going to be there, that you're going to get a new FOMC chair, that you're going to get Jerome Powell may or may not leave. And that's their position on this. And that's actually really fascinating as far as I'm concerned. I think that that's telling us a story that we need to pay attention to when one of the largest banks in the country takes that position publicly, at least. So let's look at another X page I've been looking at. I think this is one of the ones I referenced earlier. It is. All right, good. Let's take a look here at the social view. Boom. There you go. I really like this view. I hope you guys like it too. 20% of U.S. mortgage borrowers have an interest rate under 3%. 1 in 5. Wow. That's a big number. There you go. There's the chart. And while that's up there, I'm going to take a look at Instagram, see who's in the feed. Yo, what up, Instagram? What up, feed? I know that I've been trying to juggle a lot of things here, but I see you. I see you, Saeed, joining. Wow, Vic, B, everybody's there. It's nice to see everybody joining. This chart, I think, is important for us to talk about and to walk through. This is the interest rates on outstanding mortgages as of December 30th, 2025. So this is not dated material. This is relatively new. 68.6% of U.S. mortgage borrowers have an interest rate under 5.0%, according to FHFA. Of course, the most notable portion of this is not that you got those under 6%, 21.2%. Not those who have 5.1, 5.0 to 5.99%, 10.2%, but the rest of the chart, this blue section here, 4 to 4.99, 17.1%, right? Here you go. 3 to 3.99, 31.5%. And below 3, 20% of the market, 1/5. Wow. That is wild numbers as far as I'm concerned. And I don't really know if what we're seeing right now in the market is going to move the needle. If you look at where the treasuries are today, and I don't do this very often, I've got to figure out a way to really get this into the show in a way that I like. But as of right now, I haven't found a way to do it with the hedge fund modeling I want to do. Let's look at some of the bond prices, shall we? 10-year bond right there. There you go, 4.179. It's actually up on the day. So this is going to keep mortgage rates propped up a little bit. Let's look at some of the U.S. stuff, actually, before we move on. I think there's probably some value in this. Oops, sorry about that. Let's go here to the U.S. Dow Jones, we'll cover all the markets. The VIX, I don't like the VIX for most people because I think for most people, they don't understand what these numbers mean. We routinely tell people anything below 20% is pretty healthy. So our synthetic risk model in the future is going to be, I think, our solution to the VIX. I don't think this is going to be very helpful for most people who are watching who don't have an institutional background. And this show is really meant for everybody. And there's going to be a good way we can bring in the experts with a little more of a quant-driven volatility index. We're going to use a synthetic one. But here you go, 15.05%. It's up slightly on the day, but this is not what I would call scary territory. You did see a blip up here, right there, back in April, and that was a pretty significant open and close, 44.04, and a high of 57, low of 36. But again, anything below 20, which is really this line down here, is what I would say not to worry a whole lot about, and that's where you see the majority of the line falling is below 20. So there doesn't seem to be a lot of fear in the macro picture. So I guess it could be much ado about nothing. It could be a wait and see approach. It could be a lot of different things, but certainly there's not enough, in my mind, mortgage meat on the bone for the things that we're seeing and hearing to, number one, impact mortgage rates, and number two, for those rates that are impacted, even if you fall below, call it high 5%, low 6%, where we sit today in the 30-year spectrum, down even a little bit lower than that, you're still not going to get the majority of Americans to move, which doesn't create more action in the market. It just takes up more supply if they do move. So I don't know how you're going to solve the supply demand issue, which has been a big rhetoric. I do think that a couple of people that I follow, Logan from Housing Wire does a really good job on defending this. He defends it a little more viscerally than I like in some moments, but I get where he's coming from and why. I don't think that I think they've done a good job of doing that. Let's go to oil prices for a little bit. One of the things we talked about on the show in a previous show was that oil prices were going to drop as a result of the Venezuela situation. And as a matter of fact, that's exactly what we're seeing here. My sister who's watching said, I'm having a hard time reading the stuff you're talking about. Well, great. Because the vertical platforms are supposed to be an introduction to what we're doing here. If you go to LinkedIn, you go to X, or you go to YouTube, you can see it in horizontal format on your mobile devices. And I promise you, these pictures get a whole lot better when they're bigger. So whenever I do something like this, and then I click on something, you actually get a really good view of the chart. And I think it makes a meaningful conversation happen there. Sean, what's up? Actually, let's since we're talking to some comments before we get to this, let's go back to the desk here for a second. Let's go, Sean. Should we all just take a small haircut on mortgage rates? No. Matt Hayes, what's up, brother? Let's see what we got here. Here is a great research article from the Federal Reserve Board on the emergence of single-family rental institution backed from 2015. Okay, I'll take a look at that, and if it does, I guess, refute some of the things that we've been talking about on the show, we will bring it up. Matt Hayes, if you guys don't follow him on LinkedIn, has done a really good job of spending some time dialing into some of the data and analytics, and he and I often go back to back collegially talking about some of the things that we think are important in the economy, and I think he's a valuable resource. You all should give him a follow should that come up. Let's see here. Let's see what else we got in the comments. I apologize. I've been neglecting a little bit. Look at you guys going here. Can pop. That's right, Regil. Oh, here you go. Bet all the tricks will be pulled for the midterms. That seems to be what this is shaping up to be, and that's kind of what I'm alluding to when I say there's not a lot of meat in the bone with some of these solutions. They seem to be fanfare for what we know is the public sentiment around things. So if we know the public is generally concerned about house prices, and those are a really big concern, I think we're playing to that ear. And if you look at social media, there's certainly a lot of tension on both sides of the aisle as it relates to what is or is not the likelihood of success and the merits, and how intentionally emotional people are around what is largely the single largest investment that they tend to have. So yeah, I think there's some meaningful stuff there. Let's go to my beta test of the markets once again, just because I'm super excited to use it. So I apologize how rough this transition is going to be, because normally when I do this, it's going to look a lot prettier. But there's your stocks, the chart that you guys already know that we do, but we're going to swap that out for the status one here. Again, we're still in a mixed day. There seems to be no clear trend arising from the trading activity. And for those of you who didn't tune in at the top of the show, this is our risk profile for U.S. markets using ETFs as proxies for the indices, coming up with what we believe is a proprietary indication of what the market is currently doing based on the activity in these ETFs. You can see that the Dow, the S&P, the NASDAQ, the Russell, and the Invesco QQQ are all trading up right now, erasing losses that we saw earlier in the day. This does not seem to be a tech-led run day. This seems to be a mixed day across all fronts. And those of you might be asking, okay, well, Chris, you're tracking the ETFs, not the actual indices. Yes, but the percentage change is the same in the ETFs, which are just a little more available as far as I'm concerned. Number one, publicly traded markets, liquid markets, and they don't have a lag that some of these, you can halt trading, for example, on the Dow and everything else. So I think this is a better indication of where the market's going to go. And again, for those of you who didn't tune in at the top of the show, we are going to put the definitions of what these things mean right there at some point in the future. So not to worry if you're watching saying, I still don't understand what the chart means, Chris. We're going to get there. And then I will layer on a synthetic risk chart at some point in time. So that is our newest toy, if you will. I'm very proud of it. But let's go back to the screen view here. There it is. This is the U.S. Gas prices. It's fallen to its lowest level since March of 2021. You can see it's fallen straight down there, and that was expected. You can't say there's going to be more oil available in the markets and not see ramifications like this that actually happen and meaningfully move the market. Now, I would say that some of this is a bit anticipatory. You still don't have U.S. oil companies there. You still don't have refinement taking place. Still don't have shipping happening. I still think the long-term play in this space is likely to be the refiners. I don't know if the shippers are going to benefit a whole lot, and certainly the sellers of raw petroleum aren't going to make a whole lot more money. And again, this all depends on whether or not Venezuela actually has the amount of oil supply we think they have, because that could very well be not the case, frankly. So, food for thought. We'll just let that play out a little bit by ear. All right, let's see. This is actually interesting. I didn't see this earlier, but gasoline prices. No comment on that. Let's pull away from this screen for a second before I get myself into some political commentary trouble, because I'm not going to do that. The raw stuff we save for the podcast, which you should listen to, the Higher Standard Podcast, which drops a new episode every Tuesday, including next Tuesday. Saeed and I have a good one in store for you. He thought it was one of the better episodes we've done in a long time. I think so too. I've listened to it a couple times since then. I think let's go to some stock charts and see how the market's moving today. I want to see how things are pacing. So you got some companies are down. You got Exxon, Chevron, some of those companies that are up. Let's go to the chart work section here. I think this is always a good thing for us to look at. I want to take a look at how some of the oil companies are moving. So CVX, let's look at Chevron. All right, jump in here a little bit. Okay, so there you go. There's today. So down incrementally on the day, but when you look at it from a larger perspective and we generate a 1-year chart, it's going to turn green for us. There we go. Okay, seems pretty healthy, so I'm not too worried about it. Let's take a look here at some others. All right, I like to look at some of the proxies. So, somebody actually just asked a comment I think it's worthwhile to share. You're going to see a bit of a difference here on this chart versus down below. One of these is intraday comparing to the previous day. These are real time comparing to all the trades that happened recently. So there is some disparity, but they're supposed to give you some perspective and actually be good. So they were intentionally different numbers. So don't look at this and freak out and think to yourself like, oh my God, these numbers don't align. They're not supposed to align. Let's go to the comments real quick. I haven't done that in a while, and I know there's some stuff there. Actually, I haven't even checked the chat. Shall we do that? Let's do that. There we go. Oh, there's the article, Matt. I appreciate it. I didn't get the full breadth of the article on the Restream chat that I used to pull stuff in. It didn't show me. Oh, there it is. Okay, perfect. Large scale buyer to rent investors. Interesting. I'll take a look at the article now. Okay, give me 1 second. Let me pull it right up. And for those of you who want to see what that looks like, I'll pull it up for you. So please hold. There it is. So get rid of the chat here. I'll bring that bad boy on here on the overlay. There it is. If you guys want to check it out, it might be cut off a little bit towards the bottom. It's a long comment, but I'll find it. I'll find it. All right. Matt, if you're still watching, send me a DM with it. I'm actually having trouble pulling this up with the current setup right now. I don't have an ability to copy and paste it quite the way I used to, just because I'm using 2 different systems here. Actually, no, that's a lie. Hold on. There it is. I got it. Just kidding. All right, let's go to the screen view. Here it is. See, I'm still trying to use my own tech here. So Finance and Economic Discussion Series, Divisions of the Federal Research, Statistics, Monetary Affairs, Federal Reserve, Home Board here. There you go. Let's zoom in a little bit so those of you watching don't think that I'm crazy. So this is a bit dated, but okay. In 2012, several large firms began purchasing single-family homes with the stated intention of creating large portfolios of rental property. Yeah. We present the first systematic evidence on how this new investor activity differs from that of other investors in the housing market. Many aspects of buy-to-rent investors' behavior are consistent with holding properties for rent rather than reselling quickly. Additionally, the large size of these investors imparts a few important advantages. In the short run, this investment activity appears to have supported housing prices in the areas where it is concentrated. The longer run impacts remain to be seen. Interesting. So this from September 14th, 2015. Good catch, Matt. I like it. Let's see what else we got here. Looking to diversify into some energy ETFs. Any suggestions? Not off the top of my head, because we've spent some time. We've been spending a lot of time doing some of the quantitative analytics around the macro show. So we've been looking at the macros, the market, synthetic risk indicator, stuff like that. But I will be looking at some energy ETFs in the not too distant future. Again, know that ETFs, in my mind, don't tend to move as well as individual stocks do. So if you're going to go that route, just expect your returns to be somewhat blunted by the macro space. That being said, we are big believers in the energy space at this particular time. We think that is probably one of the emerging markets that's going to see a lot of value, particularly if you believe where the tech sector is going. And we do. We back that wholeheartedly. And because of it, I think that's where you're going to see some pretty outsized growth happening. You saw a little bit of that commentary come up with the news that I think it was Google, or that partnered with was it Google, or was it I can't remember, partnered with nuclear power to get that done. I got to really interesting. All right, I appreciate you, man. Okay, so calling on credit card companies to cap credit card interest rates. Yeah, Saeed's comment. Let's actually bring that up real quick. I'll bring that on screen. I've never done it over this particular display, but let's take a look here. I think that's where are you at, Saeed? Sorry, there's a lot of comments. Let me find you real quick. There you are, Saeed. I got you. Calling on credit card companies to cap credit card interest rates at 10% is like me calling for world peace. I'm calling no one is answering. Yeah, I don't think that that's going to happen either. I think that's again playing to a little bit of the political stage. So I don't know that that's actually a real thing. Again, this is again, and I keep hitting this point home. Is you're seeing a lot of things that really appeal to most Americans, which I think is driving some volatility and stigma in the markets. The markets themselves, from a stock perspective, are not buying it. And certainly, as you spend some time diving into the realities of these things being implemented and impacted, I don't know that it's as black and white as most Americans would feel. And this gives me vibes, if you will, of what happened during the student loan forgiveness. We told a lot of America this was going to happen, and Americans responded believing it wholeheartedly. But there was always a constitutionality element there, right? And I am an attorney. This is not legal advice, but similarly situated people being treated differently is kind of like your baseline setup for constitutional law violations, right? So, and a great example, use case of this in the case of student loans was always something that I thought was really just not spoken about, and that was if you did the fiscally responsible thing, and let's transition here. If you did the fiscally responsible thing back then, and you had government-backed student loans, think like FAFSA or something like that, and you had a rate of 7.5%, and you decided that you were going to do the responsible thing as a working adult and continue to make your payments, but refinance those down to a lower interest rate, which everybody should be interested in doing at some point in time, assuming it's not cost prohibitive, and it's generally not. And you took a private lender loan instead. You refied your loans with SoFi, right? Refining your loans with SoFi would have meant that the government could not have forgiven your student loans without impacting their private business, which meant that anybody who did the fiscally responsible thing would not have been entitled to student loan forgiveness. And I know there's people who believe one way or the other about fairness and equality and how this should or shouldn't work. And I'm all for example, military and them getting student loan forgiveness. And, we appreciate their service. And certainly sectors of people who I would say are unique deserve that. But you need to justify it from a constitutionality perspective. Similarly situated people being treated differently. What is the reason they're being treated differently? You're active duty in the military, that's enough reason for me. But then I say, what about nurses? They're underappreciated in this country. What about teachers? They're underappreciated in this country. Like, where do we draw the line of where that goes? Do we do it on an income-based perspective? I don't know. So there was always a constitutionality element with student loan forgiveness. And I think that's the same thing here. You're seeing with a lot of the commentary we're seeing right now on social media and everywhere else is that you can't have this unilateral, I'm going to do X without these challenges. And in the tariffs, you're seeing this right now with tariffs, right? And there's now a problem. We put tariffs in place. This is being challenged in the Supreme Court. And if they come back and say, no, these are illegal, you've got trillions of dollars that have to go back to people that you just have to give back restitution at that point in time. Like, what are we doing to ourselves here? But yet we already implemented it. We're asking for forgiveness, not approval. And there's a lot of this that's happening right now. And some of it's good from a psychological perspective that we're challenging things. But again, this is a show on business and the economy, not on politics. And these things bleed into business and the economy, and they change a lot of the things that we think that we do. And there is the human element, the behavioral economics piece, right? Humans hear things, humans react to those things. And so much of the market today is driven by retail traders. Shout out to Robinhood and the team over there, right? Like, they have impacts on the market. It's not just institutions anymore. Retail traders move a good amount of the market. We really should, Saeed, if you're watching, we really should do an episode and run down the analytics of how much retail trading really owns of the market these days. I think it's a lot more than people think, certainly on trade volume, but on dollars too. So let's get back to this article that Matt Hayes provided. I think it's a good one, and I think it's actually got an interesting perspective. I'm excited to read here. So we know that additionally, the large size of these investors impart a few important advantages in the short term. This investment strategy appears to have been have supported the house prices in the areas, but we don't know what the long term are. It gets into this pretty interesting. So in the aftermath of the financial crisis, the Great Recession, the supply of vacant homes far exceeded the demand for owner-occupied homes. And I can say right out the gate, I'm just foreshadowing here, they're saying that that's why the impacts of institutional home buyers may have taken a little bit longer for us to see or at least feel. This severe imbalance presented a unique opportunity for investors to purchase a large number of single-family homes, often at distressed prices. Yep, 2012 is when I bought REO homes. In 2012, there you go, a handful of large private equity-backed investors, of which I was not, began purchasing single-family properties with the stated intention of creating portfolios of rental property that would be substantially larger than any previously seen holding of such properties. These investors argue that the drop in the home ownership rate was likely to persist, strengthened by tight mortgage financing conditions and greater economic uncertainty, which I think persisted for quite some time, and they were accurate, making the market for single-family rentals a good long-term investment prospect. It certainly was. Look at where home prices have gone. In addition, they argue that they would be able to manage these portfolios more efficiently than smaller investors due to economies of scale and technological innovations, and that's generally true. Yeah. Although I would say there's some pretty interesting things happening in the economy, but I think that that's true, and I think that there are some smaller technological options out there. Myself, I've got a property management business. I've got some real estate business, and we use a lot of companies. Buildium, for example, runs the property management side. So there's a lot of technology that the smaller investors can use, but we don't have the benefit of the scales of economy, particularly for R&M and capital expenditures and things like that. They just get better pricing. This paper presents the first systematic evidence of the purchase behavior of these new investors. This is, again, 2015, which we refer to as large-scale buy-to-rent investors. Our goal is to assess as to what extent these investors are following a business model that is distinct from other investors in the housing market, and what the short-run impact of these investors has been in the housing market. It's sensational. Thank you, Matt. I'm going to read. We talked about America Homes for Rent, which is a big buyer in the market, impacted recently. Starwood, big one. American Residential Properties, fantastic. I'm going to read this, and we'll do a little bit of segment on the actual podcast, I think, where Saeed and I go over this, assuming Saeed doesn't tell me that I'm crazy. He usually does that a couple times a day, so I think this has got some meat on the bones here. Thank you for sharing that. I think that's a really cool thing for us to review. Let's see here. Now, back to the desk view, shall we? Enough of me reading to you. I know nobody likes that. Let's go to the socials, shall we? Because this is supposed to be a more engaging type show than most people experience. So in order to do that, let's go into the social channels here. This is actually interesting, and I haven't covered a whole lot of this. I'm going to do this briefly on the show. This has been interesting to see. The Iran is fully prepared for war if outsiders interfere with deadly protests. I'm going to forego the stigma here of the obvious political stuff. Number one, my heart bleeds for this country and what they're going through. I don't publicly talk a lot about a lot of the political zeitgeist as it affects other countries. Venezuela, I was actually stunned to not see this type of behavior in Venezuela. And if you look at Iran in the 1960s and 70s, it was a beautiful country. Lots of Western culture influences, and a lot of that changed. It's really interesting to see this. I don't speak about it publicly, but I do watch it pretty aggressively. Pretty much every day I'm getting some type of update and trying to see what I can to figure out what's going on. It'll be these types of protests have happened before, and they've always been kind of crushed. One day they won't be. And it'll be interesting to see how the U.S. gets involved if they do, given the nuclear positioning. This is not Venezuela. Venezuela had their president removed. You haven't seen this type of political unrest and civil unrest in the streets. You are seeing it here, and the U.S. is not interjected. This is just because they just feel so culturally oppressed, and it's going to be a fascinating watch. But I will apologize in advance for future shows where you see that here. California's wealth tax is threat is sending billionaires buyers to South Florida. Yes. So you are seeing the mass exodus outside of California come back into California a little bit. We've seen some California growth in population size over the last couple of years, which has been a little bit different than what we're hearing the narrative be. And certainly you're seeing the wealthy leave, but it is driving business owners out of the state still. And you're seeing a pretty healthy change there. Over the last several years, you've seen about a 30-ish, 33% increase in tax and just cost of living. And you're not seeing the benefit of that as a resident of California myself, living in Southern California, as I say that to you. 100 billionaires in California are all on their way to Florida, and our phones are ringing off the hook. Bespoke Real Estate's Brett Harris, who was involved in a separate $100 million plus sale of waterfront land in Coconut Grove before the end of the year, said this latest wave is the 1% of the 1%. Yeah, the business owners, the billionaires. I believe that wholeheartedly. Everyone thought it was going to be a New York Mamdani story. Mamdani. I never say his name right. I always actually M-A-N. It's Mamdani story. But it's been a California story. Cola Bankers, yeah, and I think that's true. I don't think you've seen a lot of benefits here. Here we go. Stranger Things. I wanted so hard to believe in conformity gate. I didn't get there. You get to see my profile, what I follow, by the way. And this is awkward for me as it is for you. It's true. Millions of credit cards could be canceled by Monday due to Trump's push for 10% cap on credit card interest rates. That's not going to happen. That's completely that's what we like to call fear mongering, kids. Don't buy into it. Shout out to the homies. You will see if I follow you on Instagram, you're probably going to show up in this feed at some point in time. My guy Matt, by the way, sensational to watch. Let's listen to what Matt's got to say. He's got some good stuff from time to time, and I'm a big fan. So let's listen to him on the show.
At some of the takes that I'm hearing from people in real estate, people in mortgage, random people that think they know what they're talking about with this. I'm just going to give you the facts. What actually happened yesterday with mortgage rates? What was the mechanism behind it? How did it happen? And then what does it actually mean? What are the implications for you as a potential home buyer or someone who's looking to refinance their mortgage?
We need some sound
so to
ending,
back up
Matt.
first, on Thursday night, Trump tweeted that he is instructing his representatives to purchase $200 billion worth of mortgage bonds in an effort to reduce mortgage rates and make housing affordability a little bit better for the US. I think it's first really important to understand how the mechanism works. How does buying mortgage bonds translate into lower interest rates? So basically, all the mortgages that we have in this country, after you actually close on the loan, that loan is then packaged up with a bunch of other mortgages, and they're packaged up into these securities. They're called mortgage-backed securities. They're just a bunch of mortgages, and those get sold off in the secondary market. Now, other investors purchase those mortgage-backed securities or MBSs, and the only thing that directly dictates mortgage rates is the day-to-day trading of mortgage-backed securities. So the more demand there is for mortgage-backed securities, the higher the price goes. And since they're inversely related to mortgage rates, that means the higher the price for the MBS, the lower the mortgage interest rate that you're getting as a homeowner. So Trump is instructing Fannie Mae and Freddie Mac, two government-sponsored entities that normally purchase mortgages, to go in and purchase $200 billion worth of these mortgage bonds. Now, for some historical context, the last time the government did this, they purchased $1.4 trillion worth of mortgage bonds, and that was during COVID. And that translated into a severe interest rate drop down to an average rate of 2.65%.
Can we give him a shout out for the mustache alone? My guy Matt's going to be a new dad here coming up soon. Congratulations, brother. I'm excited to see your journey as one dad to another, brother. It's pretty cool to see your friends start families and build things. There was a question in the chat as it relates to silver, and that has been an interesting conversation as of late. The silver investment landscape generally benefits, in my mind, from the gold one. Actually, let's see if I can find that in the chat real quick. Hold on a second. If I can find it, I will. Interesting, my chat's not pulling it up. Really weird. All right, that being said, I do think that silver is a good investment. I do think that the valuations you're seeing are probably going to be right. I think you got a bullish moment that we're in right now, and you got some strong sentiment around it. The prices have surged for those of you who haven't followed in recent months, and I think that's important because there's some analysts who believe strongly that you're going to see this growth continuing into 2026, and here we are. Do I think that it's going to see triple-digit levels this year? Yeah. I think you will. I don't think it's gonna be, you're currently trading around 75-ish last I checked. I probably have to, let me go check actually. 77.84. So yeah, I think it's got upside. I think you got some interesting stuff here. As far as an investment goes, I will say that I don't necessarily, I'll make sure I phrase this right without making anybody feel like I'm demonizing the investment, because I do like it as an investment. Generally speaking, okay, and I'm going to be general here, you don't get dividends from holding gold and silver, okay? So I like dividend-producing products. Granted, we're in an economy where dividends are being produced at a lower cadence than it had historically in a number of decades, so grain of salt there. I like to hold assets that pay dividends unless I'm doing something that really appreciates consistently over time. I think Bitcoin, the QQQ are great examples of that. Those have outsized growth. I have never been a gold and silver guy. That's not to say that they're not great investments and that people shouldn't, diversify into them. I've just personally never been close enough to it to really feel comfortable telling people that I believe in the product as a growth vehicle or as a hedge. I think on a previous show we talked a lot about the QQQ and Bitcoin. I'm a big believer in crypto in that space as well, but certainly If you look at the chart that we created before, we're tech focused right now, and some of the analog stuff, which I know will come back in vogue, like gold being a backstop. But we went off the gold standard, grain of salt here, and precious metals. Precious metals is a huge conversation to start, I think, Q4 of 2025, and we saw a little bit of that rhetoric die down. I think precious materials as it relates to batteries and energy are going to continue to be pushing the envelope, but I don't know how much precious metals are. I mean, obviously there's a finite number of this product, right? Which is part of the reason why Bitcoin is what it is. But I don't know. I don't know enough about the space to feel really comfortable suggesting that people go heavy into it. I know there's a lot of people who believe in it, but I'm not a precious metals guy. So just my perspective. Not saying because I don't believe in it. Just never spend enough time to really dig my heels in and research it. And I probably should for another show at some point in time. But for now, that's kind of me. All right. It's been a little bit of a long show. It's been kind of an interesting day. I'm super excited to see Davos. I do have some questions. I'm going to open the chat up here a little bit just to talk. I do have some questions for the chat on some things that we're going to build out in the show. Saeed and I have been talking about this at length. And number one, we have the chart work here. We can bring up charts and we can look at them at any point in time. That's great. We'll do that on shows in the future. Number two, we have the market risk profile, which I demoed for you today, which shows you the market using the ETFs as a proxy. Number three, we're building a synthetic risk. Think of this as the VIX Lite or a different version of it, which is a lot more transparent and a lot more algorithm / like hedge fund based. And I think one of the things we're going to do is we're going to look at a macro calendar where we're going to pull up some macro events and bring them on the screen so that we can show you guys what's coming and when. And then outside of that, I really want to know what you guys think. And for those of you, the chat is slowing down here. I think I got a technical glitch on my end of things. But for those of you who are watching the show, I think it's worthwhile to help tell us what you would like to see. Again, think more hedge fund, like we can build analytics into this stuff as opposed to just here's what the data is. I don't like that. I don't like historically how people have said like, oh, well, here's what the Dow says. You know, it doesn't really tell you anything. So we're trying to get to a way where we can present charts that have algorithms and proprietary, I guess, math behind them, if you will. And that proprietary math will tell you, the reader, us, everybody else, what's going on in the economy. And then we're going to take that information and we're going to wrap up every show with a composite. So we're going to bring in that U.S. markets risk, synthetic risk score, bring that in. We're going to bring in the U.S. markets status to tell you where we think we're in a growth run or a tech-led run or in a panic sell. And we're going to give you a full summary of where we think the market's at any given time as a result of what we've seen throughout the show. White House says Trump administration will let the DOJ determine whether or not Powell is a criminal. More fodder for the news there. So, yeah, a lot going on. Well, in any event, we got about an hour to the close of the market. I thank you all for tuning in. We're still trying to get our bearings, but hopefully we've improved every single show. Meanwhile, if there's any questions, comments, or thoughts, you can always email us at media@higherstandardpodcast.com. There you go. I'll put it up on the screen for you in case you wanted to see it. Boom. Send us an email anytime you have any thoughts, questions, concerns, you have any suggestions, things you want to see, you can email us here and we will get back to you as soon as possible. And with that, I will say thank you all for coming. I'm going to try the exit on the official button pushing down here, which I tend to mess up from time to time. So if this doesn't work for you, I apologize.